So we were going to be looking at the moving averages. I think that's where we stop our class. We did support and resistance, and we've done the candlestick movement and all of that. So we're going to check out on moving average and also type of strength, okay, using the moving average. So one of the objective thing you're going to look at is the friend. The trend is your friend when it comes to trend. So one of the indicators that will guide us on trend is the moving averages, okay? So after drawing all your levels, so if you want more confirmation on what you think about the market, you will use the moving averages to detect that. So moving average is an trend following indicators. So what it means is that it's an indicator following is a trend following indicator. So it deals with indicator. We're going to use 3 of it. Okay, so before we use that, we're going to take note of what a trend is. Okay, so we know what a trend is when the market is certain direction, whether market is bullish, is trending up, is going up. When market is bearish, is trending down. Okay, so we have 3 types of trend. Okay, we have the strong trend, we have a strong and healthy trend, and we have a weak trend. Okay, so the moving averages will determine which trend is a strong trend, which trend is a weak and is a strong and healthy trend, and which trend is a weak trend. Okay, so let's insert the moving average. So we have 3 moving averages to determine that. Okay, so you go to indicators, and probably you now see moving average. Click on moving average. Okay, so the first moving average you're going to apply is moving average with a period of 20. So you change this period to 20, and you see here, sometimes it will be on simple, but you change it to exponential. That's MA method. You leave that applied to be on closing. You can change this color to color red, any color you fit yourself. You can also change the length of the thickness and the breadth. Okay, then you click OK. So you see the first moving average applied this. Okay. Now, then the second moving average, let me put the 3 of them, so I'll use it then to explain the strength of the trend. So you click on moving average again, then change this to 150. Okay, and then change the color. Okay, leave this in exponential, just change the style of color to, let's say, blue. Okay, so you put this, you okay. So you see the next moving average as applied, the blue, 150 EMA. Okay, the next EMA we're going to apply is 200. So you just change this to 200 period, and then you change the color, probably to color yellow. Okay, then you click okay. So we have 3 moving average, as you can see. These are daily time frame. Now, what does that mean? This is a moving average, a trend following indicator. Whenever the moving average is above the candles or the price of the commodity or in trading instruments, okay, it means that the trend is down, is bearish. So most of the time, the moving average will come and touch the the candlesticks will go out and come and touch the moving average, propelling it. Okay, so the moving average, they act like a curve support and resistance level depending on where it is. If it is above the candles or the price, it's acting as a resistance. So there's always a pullback into the moving average, and to resist, the price will continue moving down. But whenever the candlestick breaks the moving average up, it means that the trend has changed and it will continue going up. But this is style of the movements. the candlestick actually always respects one of the 2 or 3 moving average. So if it's respecting the first one, that's 220 moving average, respecting it means that it will come into it and push out. Okay, come into it as well. It's allowing it to act as a resistance on a bearish movement. Okay, so if it is doing that, if the market is doing that, you're watching it at least on patterns, it means that the trend is a strong trend. Okay, so we have now in this condition, we have a strong bearish trend. Okay, now in a situation, there's some time the candlestick will be respecting the 2 moving average. That's the 2 consecutive one. That's the 20 and 150. Okay, so in a situation or in a trend where is respecting the 2, maybe come into the it, we have a strong and healthy trend. Okay, now in a situation where it violates the 20 moving average and violates the 150, but is respecting the 200 moving average, we have a weak trend. Okay, it might be a weak bearish trend or weak bullish trend, depending on the side the moving average is. Okay, so let's go down and see. Okay, see, so you see this is strong bearish trend. See how the market is pulling, just like breathing. Okay, it pulls out, it comes into the moving average, pull out again, come into the mover, it's pulling out. Okay, so in a situation whereby we have this kind of setting, tell you a strong bearish trend, as market will come down. Okay, down. Okay, it's strong and it's bearish. It's respecting from here to here like this. You can see it's respecting the 20 moving average consistently. Okay, now let's go down. Okay, so you see, so we still are dealing with a strong bearish trend. You can see still, so the 2 150 and 100 are just, they're following it back to back. Okay, there will be some time the price might just enter into the mean. The distance between the 2 of them, the middle of the 2 candlesticks, is called the mean of the moving average. So sometimes you can just jump into the mean and return. But in a situation where it's breaking it up, it means that the trend is changing. So this is a 𝗬𝗢𝗨𝗥. 𝗬𝗢𝗨𝗥 has been strong, but you see, look at from this place, it broke it actually. It was moving within, but it went into now touching the 3 of them is also a strong. The trend nearly wanted to, go upside. Okay, but it is the trend nearly wants to break upside in this level. Okay, the trend nearly wants to break upside on this level, but it's propelled and bearish. It went into it and it's coming down. So we have a strong bearish trend here. Okay. So it is a trend. It is the moving average that will tell you, okay, where in this place now it's not too strong because it's violating, it's violating the 20. Although it's from here to here like this, it's strong. But it comes there, it was violating it, okay, but still in between it came, it was about crossing it. It's propelled back. Now it's propelling out. So this is like a good sign to continue selling this market, because if you also put your support and resistance level, you see it's like it's bouncing out. It violated it came inside and bouncing. So you can see the market will sell. You have a psychological level. The market will just sell from here to here, and you can decide to, if you are entering at this point, you put your stop loss above here, because this is like the mean. So the highest thing it means is, what does that this mean is that actually it has, you can see a small enter return, so the price can drop, okay, easily like this, or highest, if it's even going to go back into it, it can just trend and was supposed to go stop here and sell again, okay, and sell again. So you can decide to sell again. So with this now, you are using the moving average, okay, or you see this, even if you use the middle, the mean, so your stop loss can be somewhere and your take profit is there, because Actually, the trend was down. It broke the trend, a retest of the moving average. So we believe that the price will continue selling. So this is the methodology, the eyes you use it. You use to check the moving averages. So this explain the bearish moving average. So in other words, we just explain a bearish trend, a strong bearish trend right from the higher time frame, okay? Because it's respecting the 20 moving average, and we come to the lower time frame, we see the way it is in. It's also giving us, coupled with the candlestick formations, we can see that the moving average and analysis is giving us a strong sell, because you can also look at this place where the market turned in that place, because it went into the mean between this and this like the mean, and also we have another edge here, so the market fell. So even when you are here, you can as well sell and catch this trend. But meanwhile, after the market went bearish, what happened? It came back again and retouched the moving average. So it respects the moving. You also look at the candlestick there. So it respects the moving average. So we believe it can still going down, because we are dealing with what? A strong bearish trend. So if you look at even from here, you can see that the market has been trending down. The market has been making just pull into the moving average and trend down, pull into the moving average and trend down. So depending on the touches and how the touches occur. So if you look at sometimes it violated, so you will know whether it's a strong and weak trend. So let's check that of a bullish, if we can see. Yeah, okay, so if you look at this one very well, let me go to our time frame making all this sense. Now remove one moving average. Okay. So this for the bullish movement. Let me just put more color into this. Okay, so this is you can see the moving average, how it's this, if you touch it, you see these are 20 moving average, this 200. Okay, let me just put the 150 moving average. Okay, so this is 150 moving average. So if you look at this, this bullish, this is a bullish trend on this, but it just started. Okay, so the trend, if you look at from higher time frame, you see the moving average are not that effective, but we want the price crosses all the three moving average and is above it, means we are now dealing with a bullish trend. Okay, when we were here, we're dealing with bearish trend, so it changes here, see, and crosses. We dealt with bullish trend. It was respecting the 20 moving average, even when these ones were not ready. So there was a weak trend around here, because it was not, if you look at this region particularly, you're going to see that the candle was not at this place, at this particular region, the prices, okay, we're not respecting, on this particular time frame, we're not respecting the moving average. It was just moving zigzag, although, or you can observe very carefully and see that it is only the 20 moving average that it is respecting. So sometimes I'll just be respecting one. So let me remove the 120, the 150, and then the distance. So you see this explanation and the 200. So along this, now you can see, and the price was moving down. Okay, so it's respecting this is strong bearish trend. When you get to this level, it stalled, it started consolidating, and finally it broke the moving average. It started respecting the moving average again, coming a strong trend, come back. So you can see every time it's far away from the moving average, it has to come. So this is another way to also, so if you are trading and you are, maybe the price is here and the moving average is here, so you want to wait until the price drop back to the moving average. So if it is bouncing off it, that is when you want to buy in the other direction. But sometimes you also need to be careful, like from here, it broke it. Instead of bouncing off, it broke and started trending down. But you see from this distance also, you can see that it's far away from it. Then it came close into the moving average and it didn't even bounce from it. It started respecting it again. It means that the trend has changed in this place. Even apart from the observation, you can also check the trend, that the trend has changed from here. So to bullish trend. So you can easily look at it from your eyes, as a respect, and sometimes. So now we're dealing with a bullish trend, okay? We're dealing with a bullish trend, but is it strong and healthy bullish trend? So you have to put the other moving average to determine that. So to put the other moving average, you have to also go to lower time, because if you are looking at it from this particular time frame, you will see that actually it is not too pronounced that the moving average is respecting any of those, okay? So I will give you a guide on, okay, so you can see from here, what you just need to see in this particular place, all the moving average are below the price. And if you zoom very well, you can see that we have a strong trend actually. So the what can only tell you that is a strong bullish trend is your trend lines, okay? So because it's straight, trend line is not curved. So, but we can see that as it's respecting the trend line, it broke and eventually is above the moving averages, telling us that this is the bullish market has come in. So you come to a lower time frame and see how the price are reacting. So you see from 4 hours, I started respecting it. It's so clear that it's respecting the 20 moving average. In fact, it was this place that it broke, even with if you also draw levels, you can see that it broke. This is when it break out. You can draw this or draw this. Okay, so it broke out and then continue respecting the 20 moving average. So now from this session, actually, we now have a strong, because two of them, these are below it and this one is very close to it. We have a strong bullish movement. We have a strong bullish movement. Okay, so the trend is turning up. So you can use the trend line or you use the moving average. So you can see how it's respecting the moving average, it's respecting the 20 moving average. We have a strong bullish trend. So if you come to 1 hour, you can see that this is it. Okay, it broke it in this level, started trending down, but when it touches, okay, so here we have, now you see the word change here. In this trend from here to this place, we have a strong, and healthy. Okay, it's strong and healthy. Okay, healthy in the sense that it is respecting the 20 moving average. I know it's not respecting the 20 moving average. Okay, overall, if you're looking at it overall like this, okay, but it came here and it respects the 200 and also the 150 moving average. So that's what we call it, is strong and healthy. So start respecting them from there. Okay, so we might get, as it gets to this place, we might just be careful if it will not default this way it defaulted here. Okay, then and come and retouch it. So if you retouch this will also be a good level for you to buy. Okay, so you can buy from here, because now you see the way it respected them here, respected. So it's very, very healthy. So when the candlestick is just persistently respecting a one moving average, peradventure like the 20 moving average, is a strong trend, but it's not too healthy because it's far away from, just like for this place. If you look at it in this place, okay, you can see that it's consistently respecting the 20, but it's far away from it. So any small thing, it might just break out it's strong, but it's not too healthy. That's why it broke and then retouched. So immediately it's retouching. This one is stronger than when it's touching just this somewhere like this. So we have to touch it because although it violated the 2, it violated the 20 because now it's below, but we have 2 strong ones. That's the 150 and 200. So it came into the mean of it and it's bounceable. So once it's bouncing, maybe probably you're somewhere here is a good entry to buy. Okay, so let's say you buy from here, you can see that you can trade, you can trace it until you get to this kind of place that is a strong, now it's not a strong bullish trend. Okay, although it might just start, continue working small, but any single mistake might just broke out into this. So if a conservative trader, probably if you see this on a lower time frame, it might not happen on a higher time frame, but you see this on a lower time frame, we want to see that the price actually break and touch this mean of the 20 and of the 150 and 200 before it can decide to buy around this level. Okay, so that's, you just use the 3 moving average to make a decision or adjust your decision per time. Okay, so that's why. So what you need to learn from here is that we have strong trend, strong and healthy trend, and a weak trend. So let me find a one that has a weak trend. Okay, like I've just explained it from here, like this is a weak trend. If you just maybe see something like this, when the price is not respecting any of the moving averages, it's a weak trend. Or peradventure is just respecting the 200 moving average. I want to see. Okay, look at this please now. This market is flat. It's not respecting any of them. Okay, so this kind of level is called a weak trend. Okay, like this one is bearish actually. So if you look at it this way, you can see that the price is going down. Okay, the price is bearish, which is like we're dealing with a bearish trend. Let me just draw the levels out. Okay, probably something like this. So we're dealing with a bearish trend, but it's a weak bearish trend because it's not you can see from inside this ball, the market is not respecting any of the moving averages. Okay, so eventually that time, you want to use your trend line to detect, okay, where your entry should be, not the pull into the moving average. Because some people, okay, because you are taught that you are to buy at a pull, just like this, at a touch of the moving average, and sometimes market does not really touch it. It's not even consistent with the touching like this place. There's no touching, it just the candle is just breaking it. Only thing you can know is when it is below it, you know the trend is down. So what if it's not being consistent like what we see here? So if you look at this, look at this one, there's a touch here. So we know, yeah, we're dealing with bullish market. It came close and then went again, came close until it broke it. Okay, so but here he was just moving into, it's not expecting the moving average. So we call this a weak trend. There's no, see, there's no touch, just go into it and out of it. The market is just going into it and out of it anytime. So this is a weak, this, like if you see a movement like this is a weak trend. So you want to, so maybe if you're, that's when if the moving average can be closer for you. Sometimes people don't like using moving average because it's a lagging indicator. So we want to delete them and use your normal patterns. So like this now, we can see the pattern easily that yes, this is a top, and as the market touched down, went into it, out ahead. So this is very easy for us because we know that these levels here are the psychological level, depending on the candle. This one, although this one break out, depending on the candlestick. So another thing is a market about touches. Let me use this to explain about touches now. Like when once the market has a 3 touch, the 4th touch, just like this one, this 1, okay, this 2, okay, this 3, okay, this 4. Okay, remember we talked about reversal. So the 3rd touch has a high chance of being broken out. It's just like you're sledging an hammer on the wall. So the more you sledge the hammer on the wall, the weaker the wall becomes. Okay, so when the market, this is a bearish trend, and we know is a channel. When we have a bearish channel, we explain it. I just want to use it to explain on it. So when once we know we have a bearish channel, whether descending channel, we know that is a continuation pattern because the price is coming from below. So it's going to be a bullish continuation pattern because after the market enter into this channel, that's when it starts stalling down. Okay, so there's high chance that it will broke out. So the way or where we, you know, I explain this, I explain how to trade breakouts and all of that former class. So one thing you need to know is that okay, so I explained how to trade a breakout and false breakout and all of that. So and then the pattern. So like this case now, you know, the price is moving and it's going down. So if it is on higher time frame, you can trade just like this one. You can trade in between the trend, in between the patterns, in between the channel or triangle. But if it is on lower time frame, you want to wait for a breakout as well. Okay, so sometimes breakout also happen on higher time frame. But for you to be able to trade a candlestick or market in between, you want to see the touch. Okay, so sometime when the market touch this place, okay, there's no guarantee that it will come down, but if it has a two touch, okay, that's when we now have something called double touch. So normally you see the market touch this place, you want to sell. Okay, so as you sell, immediately it's touching this place, you exit. Okay, so and you buy. If you see a good buy candle and go here, you exit. Okay, so now this become one touch, this become two touch, this become three touch. So immediately it's not breaking it didn't break out and start going up because we expect the price to go up on the third touch. You just allow it to fall. We can sell also to this place, and we have this place. Under this, we have also the touches. But let me explain this one first. So with the price would start going on. So as it's going for the fourth touch, there's high chance that it will break the trend line, and that's what it did. So it broke the trend line. It came down. So this is like a retouch now. Okay, so you put your trend line, a retouch. So if you want to trade aggressively, you can enter this place. If you want to be conservative, I've explained all this thing. You enter after a retouch, then that means you buy from immediately it retouch this place, you buy just one touch. Now using that for the lower time, for the lower channel, okay. So you can see this like under this place, you know, it's more solid, although okay, so we can say maybe 1, 2 touch, 3 touch, and the fourth touch bounce off. Okay, so because it did not break it, that means it's going to bounce off. So you know the implication, and it's going to bounce. So the fourth touch can be a weak touch, it can be a strong touch, depending on which channel or which scenario you are dealing with. Ordinary, when you see a descending trend, you should be expecting a break on the upper side, not on the downside. Okay, so and especially we now have a fourth touch that does not break, it means you can enter from here instead of waiting to enter from here, because you know it will break out. So you know that eventually, because it's having it, because this is the first touch, second touch, it's having a fourth touch and it's on a descending channel. So that means as it's bouncing off this place, it's going to move and it might not get stopped here again. It's going to break this, because this also is a fourth touch. So it's going to break it, and you can just be rest assured that even when there's a retouch, so far you have a rest entry. Yeah, so you have more opportunity of riding the market from this place. Okay, this you have additional distance in this place. You also have additional distance, you know, from this place again. So if you understand touches, but some people just want to miss this particular distance and then enter in only this one. Okay, so you just need to get the concept of the touches also. Okay, so that's about moving average and also dealing with trend. Okay, so I believe we're clear with this. We're going to go into the pips, the calculations. Okay, we go into the calculations, and we explain entries. I've been explaining entries, so let me just use this ones as also entries before we move to another concepts. Okay, so for example, you are dealing with this and you want to buy or sell. okay, or you want to buy or sell. Okay, so what you need to do, that's we're getting into under entry now. You need to calculate where your stop loss should be and where your take profit should be first. Okay, so let me say I want to enter after this fourth touch for you. I want to enter here. Okay, so if I want to enter, let me. That's scattered. Okay, let me use after you've done your analysis, for example, let's use this one, for example. After you've done your analysis and you know the market is going up, okay, this one is a continuation pattern because we are dealing with descending. So let's say this lower time frame, and you want to enter, let's assume this is a lower time frame, and this you want to pick your entry. You know that your entry should be above the trend line, above the breakout. So probably this is a breakout. You want to enter here. Okay, and you are targeting this place. This is your next resistance. So using what we call risk to reward ratio, there's what we call risk to reward ratio. That means you are risking 1 to get 2, risk 1 to get 2. So you need to risk 5 to get 10. So whatever pips you are risking, you are going to see that your target should be doubled. Okay, so let's see, you want to enter in this place, this because of your analysis, you don't know your analysis, and you feel the market is going to go up, and you want to enter after the breakout and you touch probably here. So you are entering at 1.2469. This is your entry. So for you to be conservative, you know, look at this, you want to put your stop loss here, because probably sometimes it might just enter the channel, but you give a room whereby you can bounce out of it also. So you need to give room to the markets. Now, giving room, you will see, assume this is going to be your entry. So from here to the gain like this is almost 70 pips. Okay, let's just say 70 pips. So this is 70 pips. The one in the middle, 704. So 70 pips. Now, you will make sure that your take profit should be times of 2 of this. That means your take profit is going to be what? 140. Okay, so or more than that. So let's say this from here we have we have more than 70 pips. We have 127 pips. Okay, so if this is your target is 127, probably you want your target to be 140. You can also drag it over. At least that 127 is more than, it's not up to times 2, because it's more than the 70 pips you are losing. So let's just be good with our numbers. So your take profit should be around this particular level up here. So you can now, this is a risk to reward. You are risking this place to gain this. So it helps you, what risk to reward help you to do? It help you to put the statistical edge in your favor, in which peradventure, let's say you trade 10 times and you lose like 4 trades. Because you are using risk to reward, you also end up in profit. Or even risk, you win 5 and lose 5, you're still going to end up in profit. Okay, so let's, for example, you are risking $10 on each trade. Okay, so when you lose $10, and but when you win $20. Okay, so that's a risk to reward of 1 to 2. Now, if you trade 10 times, and you lose 5 times, but you win 5 times, or you even lose 6 times and you lose 4 times, you're still going to be in profit because of the statistical edge. Let's say, for example, you lose 5 times and you win 5 times, which is supposed to be 0, but still you're going to be in profit. So if you lose, you're going to lose 5 times 10, which is $50. 5 times is $50. But if you win, it's going to be 10 times, is going to be 5 times 10, which is what am I saying? Let me use the calculation. Okay, so if you are using ratio 1 to 2, risk to reward, we call it risk to reward is R to R. Your R to R, okay, is risk to reward. Okay. Okay, so you are supposed to use risk to reward of 1 to 2. Okay, so if you have 10 trades, okay, you have 10 trades. Okay, you have 10 trades and you win 5. Okay, 5 wins. Okay, and 5 loss, for example. Okay. So you are using ratio 1 to 2. That means if you win, you win 2 times. Okay, and if you lose 1. Okay, which is now if your bet or your risk or what you want to your stake, let's put it that way. So okay, you want to be staking $10. Okay, you want to be staking $10 on each trade you trade. So if you win 5, it's going to be times 10. Okay, and if you lose 5, it's going to be times 10 also. Okay, so yes, if you win 5, you have 10 trade, and you win 5 trade, you lose 5 trades. Each time you lose the 5 trade that you lose is going to be because you are using ratio 1 to 2, so it means that you are risking 20. Is this going to be $20, and this is going to be $10? Okay, so it means that so what it means is that each time you win 20. Okay, and each time you lose what? 10. Okay, so peradventure the 5 means that this one is going to be what? You're going to have 20, okay, times 20 times what? Times 5. That's when you win. Okay, so 20 times 5, we know that is 100 baht. Okay, so you have $100 for all your wins. Okay, so if you lose, it's going to be what? 10 times 5. So it's going to be 10 times the 5 times. Okay, so which is going to be what? 50. Okay, so you're going to have $50 for all your losing, because you're not going to win all your trades. So all your losing trade is going to be $50. Your winning trade is. So if you add the 2 of them together, what are we going to have? We're going to have $50. So at the end of the trade, you still come out profits as $50. Okay, so at the end of the trade, you still. So if you use this statistical, this thing, it's giving to you that never risk more than what you want to gain. Okay, so some people use ratio 1 to 2, or at least ratio 1 to 1.5, but that also depending on your winning rates. Okay, so this example, let's go through. You are risking ratio 1 to 2, risk to reward 1 to 2. It means that when you are risking, you risk 1 and you are risking 2. That's ratio 1 to 2. It means that whatever you are risking should be times 2. Okay, of the gain. So this is what we did. You can see it. So let's say you want to trade these, your entry is here and your stop loss is here. Okay, so this is how to structure it. This is your stop loss, this entry for buy. Okay, you want to enter or buy around this level, and your TP, which is your take profit, is going to be here. So with this now, you have ratio 1 to 2. So if you consistently pick a trade like this every time, and it might not be this setup, but it might be another setup. It might be even the pullback into the trend. So if you continue doing that, for example, probably you do it 10 times. Okay, 10 trade. That's why we have the 10 trade here. Okay, so if you do it 10 times, you have and then peradventure is 50-50 chance. Okay, you win 5 and lose 5. Okay, so the 5 here means that because we are using ratio 1 to 2, this is your risk, your reward, this is your risk. So under this, we have 2 times 10, which each stake you are staking is 10. Each time you want to make sure that you are not risking more than $10. So this $10 can be 2% of your account. It can be 5% of your account, any amount, depending on how much you have in your account. Okay, so let's say, for example, you have you have $10,000 in your account or 10,000 naira. So and you want to be risking 2% every time. So 2% is going to be 200. Okay. So if you have $1,000 in your account and you want to be risking 2%, 2% is $20. So if you want to risk 1%, which is now going to be $10. So this is like if you have 1,000 and you are risking 1%, which is $10. Okay, so you are risking 1% each time you enter a trade. You are just risking 1% of your account because you have $10, or you have $500. You want to risk 2%, which is going to be $10. Okay, so depending on how much, this is the mathematical chart, depending on how much you have in your account. Okay, so let's say, for example, you have 10,000 in your account and you are only 5% of your account. Okay, so 5% means each trade, each time you enter a trade, you are risking only $10. So let's say you now risk $10. You know your risk to reward for a venture. You did a 10 trade and you win 5 times, you lose 5 times. So your 2 ratio 1 to 2, like that one, is going to be 10 times this, which is 20, and this 1 times 10, which is $10. So if you now multiply by the number of times you win or you lose, so 5 times 10 will give us $50, which we have it here. Why 5 times times 20, because this is 20, we're going to have $100. So if you add the two of them together, you still come out profit. That means when you do 50-50. So just imagine when you have 6 wins and you have 4 losses, it's going to be much. You can do the calculation for that one. So the major thing is just make sure that you keep your winning high, okay? And even if you have 4, you're still going to be in profit. Let's say you have 4 wins, okay, and then 6 losses, okay? And you keep your transaction track, that you know that anytime you win 2 times, anytime you lose 1 time. So this one is going to be 10 times this, which is going to be 60. Okay, the FXCE is going to be 60 for the down one. Then the upper one, which is now 4, is going to be 20 times 4, which is 80, right? Yeah. So we're going to have 80. You understand? So if you add everything together and you subtract, because this one is going to be minus, you still have what? $20 as profit inside of $50. That's when, even if you lose more than you gain, okay? But because of the risk to reward, that's what it's going to give you. So I believe you understand this thing. But you understand the calculation, right? Okay. So when that happens, that's how to use the risk to reward. One thing I want to explain is how to get the 2% or 5%. So for example, just like the example I used, an account of, just giving an account, you have an account of the $1,000. So say, for example, you have an account of $1,000. Okay, so if you have an account of $1,000 and you want to risk only 2%, okay, 2% of the account on each trade you enter. So 2% of $1,000, I believe, is $20. Okay, let me be sure. So it's going to be 0.002 times 2. Okay, so 0.002 times 1,000. So okay, it's $2 then. 2% 0.02 times 1,000 is $20. Yes. So 2% of this is $20. Okay. So 2% is $20. Okay. So what you need to do, you must have trade plans. Okay. Okay. You must plan your trade and trade your plan. You pick a quality trade. You don't just trade anyhow. You're going to be a scalper, so you must make a setup that will always give you risk to reward of 1 to 2. Okay, R to R of 1 to 2. That's the most important setup that you'll be picking, 1 to 2, and you are ready to only risk 2% of your account at a time. this is under risk management now. We're going to risk management under risk management. Most people don't trade this. They don't put risk management in place. They can bet their account on a particular trade. So sometimes if it goes well, they can double the account. If others goes well, it goes well. Okay. So using professional trading means you must know your numbers. You must know your risk to reward ratio. You must know that it is a long time perspective. All the hedge fund, the secrets in it, yeah, you can make any money anytime. You can double account. You can make 100% of the account. But the risk there, you must, as a trader, you are a risk manager. You must know how to manage your risks and be consistent. Because once you are consistent, even if it is 10% of your account, you can make every month or every year. People will give you big money to manage. Because the hedge funds guys, what they do is only 10% in a year. So if you have a statistical record of making even 2% every month or 3%, at the end of the year, you make more than 50%. You are beating the hedge funds and the Wall Street guys that are having billions of dollars in their management. Because they can have billions of dollars in their management and they are just after giving, they will say, okay, we're going to give you $1 billion and we want you to give us, secured our account and give us 10% of the account or 20% of the account. So for you to be able to achieve that, you must work with numbers. Okay, most people know about Forex trading and they just fund the account and they start trading, they make money today, tomorrow they lose it, you know. But for you to be able to be professional, you must understand this number, risk to reward, how to use them, know when to pick a quality trade that will give you a good risk to reward, because definitely losses will come. So the first thing is to know how much you are willing to risk per trade. And you can also know how much you are willing to risk in a day. Okay, you can also know how much you are going to risk in a month, so that it will not be a surprise to you that you put 1,000 in your account, at the end of the month, everything is wiped out. Why? Because you do not put your risk to reward management in check. So the first idea is know that you have risk to reward of 1 to 2. So you are risking 1 to get 2. And you are going to fetch for a setups, because that setup will not come. You fetch for a setup using your technical analysis, also looking at the fundamental and every other things to make sure that if the setup has a chance of giving you at least 1 to 1.5, it should be more than at least the 1. It should be 1-1. If you are picking ratio 1 to 1, you are going to, it's going to be difficult to break even or be in the profit zone. So you already pick ratio 1 to 2, at least ratio 1 to 1.5. Some people will even say you should pick ratio 1 to 5, which is very difficult to get, or ratio 1 to 3. But you can easily find ratio 1 to 1.5 or ratio 1 to 1 to 2. Or there's a way you can put your trade in such a way that we are working in lines with that ratios. Sometimes you might not be perfect to get ratio 1 to 2, but you are working in line. That one is under active trade. You are working in line with that in such a way that you are making sure that your risk is no more than 2%. Okay, so most traders will say, okay, if you want to risk on a trade professionally, you should not risk more than 1 to 3 or 1 maximum 5. Okay, so to be conservative, you should be work between 1 to 5 or 1 to 3. So I recommend for a good trading result, you should be looking at ratio 1. To be more conservative, you look at ratio 1 to 2. If you want to be volatile, you can look at ratio 1 to 4. That means some people can decide that I'm risking only 1% of my account. Some people can fall into I'm risking only 2%. Some people can say I'm risking only 3% of my account per trade. So some trader can say I can risk 5% per trade. Okay, so I actually recommend to start with risking 2% of your account per trade. So if you have $1,000, you are risking 2%, it means you are risking what? $20 per trade. Okay, so how do you get the $20 on a trade? Okay, so we have what we call lot size. Okay, lot size. So what you need to do is lot size. You need to check out your lot size. Okay, lot size. Okay, so the lot size is the volume. I think I've explained it. It's also volume that you will use to enter a trade. A lot size, there's a formula for it. Lot size is equals to amount, okay? The amount you are willing to risk, okay, in dollar value or monetary value, okay? So the amount you are willing to risk in dollars over amounts, okay,
you are willing to risk in pips, okay? Over the amount you are willing to risk in pips, okay? Divided by, is it divided by now or times? Okay, let me use the word divided by 10. Okay, so the 10 there is constant. Okay, divided by 10. So this is the formula. It's a very important formula when it comes to calculating the something. So first of all, you now calculate, this is your account, $1,000. You calculate how much you want to risk on a particular trade is what? $20. So how do you want to, because the pips, okay, it's not always going to be the same thing. Okay, it's not like from year to year we give you $20. Okay, from year to year can give you any amount. You can decide to, depending on the lot size you use, from year to year can be, it can be $500, it can be $1,000, it can be $2, it can be, so depending on what lot size you use. Okay, so you need to determine the lot size. Let's say for your risking from year to year, because definitely you are risking $20. So from here, now this is where the I think the calculation comes. So you want to make sure that from this is your entry, right? From our example. So you want to make sure that if the price draw down and then hits this particular place, okay, because this is your stop loss. So immediately it comes to this particular price, it will take you out. So you want to make sure that the distance from here to here is equals to your 2%, okay? Is equals to your 2%, which is the $20, okay? So that's where the calculation comes in. So you want to make sure that distance from here is your 20, and then the distance from here is double of this because we are risking ratio 1 to. So distance from here should be what? Should be $40. So this is what you want to do. So you want to make sure that distance from here, because is it 40 now? Sorry, should be 20. Should be $40. Sorry, this one's supposed to be 20. Okay, why this one's supposed to be 40? Because this is what you are risking. You are risking 2% of your account on this trade. So it means that if the trade goes wrong and come down, it can go further. But you want to make sure that if it comes down, it's going, you don't want it to go further. You don't want it to take more than $20 out of your $1,000 account. Because it can go further if you don't have a stop loss. Okay, this place is a stop loss. If you don't have the stop loss, it can go further. And instead of $20, you can take maybe even the 1,000 or take 500 or take more than that. That's where we have a crashing of account. But if you set this, it means that if you are wrong, it will just take only $20 out of the account. Are you getting me? And if you are right, you want to make sure that it's double what you risk. So from year to year now, from here to that, your distance that we will calculate now, everything now, you want to make sure that from year to year, that distance, okay, you want to make sure that it's $40. So once you move up to this place, it should close you with 40, that double of what you've risked. It should close you with what? $40. So this is what you do to get that correct numbers. So we said the lot size. The lot size is what we determine that this should be this should be this. So your lot size is the amount you are going to risk in dollars over the amount you risk in pips. So the amount you are risking in dollar is the amount you say you want to read, the 2%. So it's going to be lot size. Okay, let me introduce the value now. Okay. Okay, so it's going to be lot size is equals to what is the amount you are going to risk in dollars value is $20. Okay, so lot size is going to be 20. You don't need to put the dollar. The amount you are willing to risk in pips. So you know that time we calculated the pips. Are you there? We calculated the pips. Let me even pick it so that I will not clean this. Okay, so we calculated the pips from your entry. This place is your entry, right? So let's say the market pick you around this particular price. So from year to year, we calculated it that time. I think it was 70. It was 70 pips. Okay, so that means it is 70 that is going to be here. So you now put 70. Okay, so over 70. Okay, so that's the pips. Okay, that's the lot size pips divided by 10, which is constant. Okay, so divided by 10. So you want to know what the lot size. So if you have 20 divided by 70, you know it's going to give you use a calculator where we have 20 divided by 70. Sorry, I said 10. It's going to give you 0.2. Probably approximately 0.28. Okay, so approximately Okay, how do I do this? So approximately we're going to have 0.29. Okay, so everything is going to be like okay, so everything is going to be 0. We approximate that one 0.29 because it's 0.285, but let's just approximately 0.29. Okay, over 10 because of this division, okay, or divided by 10, anyhow, it is over 10 again. So we divide it by 10 again, you're going to have 0. So your total, everything is going to be what? 0.029 or 0.028, okay? So 0.29 approximately. So this is your lot size you're going to use. This is lot size. So lot size, okay, lot size, which is the volume, for you to get that particular, because of this setup, okay, is 0.29. So 0.0, sorry, there's 0 in front of it, sorry. Okay. 0.029 after you divide, so we're going to have 0.0. What am I writing? 0.029. Okay, so this will be the lot size. Okay, so it means that anytime you want to enter the trade, as you enter the trade now, you're going to be using the lot size of 0. Because you know what you want to reach is just $20. So when once you enter this trade and you use the lot size of 0.029, then you put your stop loss here, put your take profit here, you have entry here. You can just enter this and leave your trade. Okay, maybe probably you come and watch what had happened. So if you leave your trade, you already automated the trade. So if the trade goes well and eats this, you're going to go out with $40. If you come down and eat the stop loss, you're going to go out with minus $20. So in as far as you use 0.029 as your loss size. So this is the calculation. So take care of these calculations. Then let me just clear it. So I believe you understand it. Do you have any question on this? So if you have these setups like this, then we're going to clear this.
I have one question.
Okay, so what's the question?
Yeah, so for the pips, is there like an indicator or something that will show you the number of pips that is in between in between that mean, the stop loss, between that resistance and then
from here, you mean from here? You are the one to calculate.
Yes,
that.
yes.
If so far you use your eyes, okay, to identify levels, all this one is not automated. You're the one to. So if you have your eyes, because for you to there's a general rule: buy at support. Okay, you always buy at support or breakout. Okay, and sell at resistance or breakout also. So like this condition now, you want to buy at breakout. This is a breakout. So you always want to put your stop loss below the next. You want to put your stop loss below the next support level because you believe the market should not break it. So once it breaks it, it has violated the setup. So you put your stop loss below. So that's why I put this red line. This is the region because we have a support here. We have a support here. So peradventure, this is the from here to here. This is the next support level. So if we are picking our entry at this breakout, our stop loss will be here. So once you identify that, you can now calculate the distance using the share cross. Okay. So
okay.
not like it's not you pick this share cross and try to imagine, because the price might not pick you at this constant, but you imagine that you want to enter around here. Okay, so you now use this one to drag down to where you think your stop loss is. So like on top of, you want your stop loss to be on top of this line. You put it, if you look ahead, you drag, see this is always, you see, we have, if you observe very well from the cross line, we have 3 numbers. So your pips is the middle number there. Where you see that one 710. 710.
Yes.
Ahead, that's the pips. that's the distance between that entry to down to the
Entry down.
which is
Yes.
roughly, that's why I say it's $70. So if you pick it very, you want to go after it, you have 704. So it means you ignore the third line, the third numbers, because we are dealing with
Okay.
yes, so ignore the third. If you are dealing with 4 decimal place, it will not even bring the third number. But if you are dealing with the 5 decimal place, which this chart is 5 decimal place, that's why it's bringing that third number. So you ignore the third number at the middle. So you just pick the first two, 7 and 0. That's 70 pips.
Okay.
So that's why. So it's from here to here is 70 pips. Then let's say from here again, that same distance to where you think your take profit is going to be because of the next resistance level you feel. So you drag it up to the next resistance level, or you can see that if you take it to that line, the red line, see, it's roughly, it's roughly 100, so because it's now 5, so it's now 146 pips. So we are targeting 140 or something. So if you drag it to that place, it's roughly within that price. So 100, that's the, so from here to here, you can see the points. If you are using your drag share, the first numbers 10, which is means the candle, 10 candles, while the medium one is the pips, while the last one is the price. So this like indicate, this just show you, it's not like indicator, it's just a tool showing you how far distance is.
Okay.
Yeah. So this is the, so if you drag it to show you how far your distance, you are going to drag it to anywhere you want to drag it. So to show you from here to here is 140 pips. Is 8 candle. The way you are dragging is calculated depending on the direction you put yourself. So it's 140. If you drag it down, you will say you want it to stop here, is 72 pips. If you drag it down to this place, so the prices increases. So it is this cross check that you will use to, to determine it. Yes. Is that all?
Yes, that's all. I just wanted to know whether there's a tool that we use to determine the number of pips as well. But since you said there's that cross check, no problem.
So it's a cross check now.
Yeah.
So so that's so now let me show you how to enter. So you click on, so once you have your number of head or you have it written, then you want to enter to trade, you click on this new order. Okay, so from new order, you see symbols. This is the symbol you want to trade, USD card. You see volume. This is the loss side. This is where the loss side comes in.
Okay.
So the volume, yes. So you now put that 0.02, so you can type it. Now, before we do that, I'll also tell you what each of them is. So this one, based on our calculation, we are using 0.0229. So it just 9. Okay, so that's now the volume, that's your loss size. So with that now, what this one means is that each pips move is 20 cents, close to 30 cents. That's what it means. Okay, but before we go, let's just complete that. So when you put your volume here, you put your stop loss. You can enter, then drag it, or you put it at, once you know it already, you can put it there. So let's say our stop loss is this one. Okay,
70.
Like this one now, you're not putting the price. It's 70, but you're not putting 70, but you are putting the pips.
Okay.
Will allow you to put it as based on the number of the pips. Some platform will allow you do not enter here, so you have to put price. So
price, okay.
Yeah, so this is the price that will give us that 70. 1.23996.
996.
You have put 1.23996. Yes, so that will be your stop loss. So now your take profit is going to be the one at the top. Okay.
Yeah.
1.26157. So you put it there. 0.26157. So once you put that, you come down here, execution, market execution. From our analysis, we want to buy. So you just click on buy. Okay. So you just click, once you click on buy like this, it will pick the trade on, because now, okay, we are just assuming that the price is here. This one has passed.
Yes.
When the price is, so once the price is around here, it will just pick the price around here, then wait for this particular movement to play out.
Movements.
Okay, so you just click on buy, and then by that you've automated the system. So you can decide to put on this and do any other thing and come back and check and be checking, because you've already automated your entry. So once you click on buy it, what you said is that you are buying, and this is your take profit, this is your stop loss. Okay, so sometimes a trader, sometimes signal provider can also give you entries. Okay, can give you the stop loss, and take profit and entry. That's the price you're supposed to enter. It might not give you the volume, so you are the one to calculate the volume depending on how much you want to risk. Okay.
Risk, yeah.
Yeah, so you will now know the volume. You put the volume, put your stock operating, so you execute the order. It has been automated. So although the market might not move perfectly according to what you plan, you can decide to adjust the market. We have what we call micromanagement. You can decide to manage the trade by probably taking, if it's in your direction, you can take, because look at this one, it came close to that take profit, it now came down. So sometimes it will do that. So you want to, maybe when a situation like this is happening, you want to take a partial profit. So you can also take a partial profit, or you can decide to close and then re-enter after the drawdown again, because you know it's going on. So you're just going to ride on the market. So that's how to automate a trade and also manage it. Now, let me explain this volume for you. Now, this volume on a standard account, you can see it here.
Yes.
That's the lot size. Some are already calculated. You don't need to calculate them again, depending on how you deal with your number. Now, this one, it means this one that starts with 0.01 is called the lot size. So this is the minimum for a mining account. So what it means is that each pips move is 10 cents. 0.01 means each pip move is 10 cents. So you might not want to go through all this calculation. You just know that you want to risk. You know that your stop loss is $70, and you want to reach $70. So you don't need to do all this calculation. So you can decide to go to when the pip is 1 pip is equals to $1, so that the pips will give you $70. So, but now the starting one is 0.01, which 1 pips is 10 cents. So for you to get, you know how many pips you're going to use first. So this one means 1 pip is equal to 20 cents. 0.03 means 1 pip is equals to 30 cents. 0.04 means 1 pip is equals to 40 cents. While 0.05 means 1 pip is equals to 50 cents. Then we have 0.1 is not on this place. So 0.1 means 1 pip is equals to what? $1. $1. So 0.1 is different from 0.01. So 0.1. So if you are using 0.1 lot size, you don't need to do all those calculations. You will just work with your pips directly. So that one depends on how much you have in your account. So if you use 0.01, it means 1 pip is equals to $1. Okay, so let's say you just want to reach $70. So you don't need to do all the calculation. What you need to know is the distance between your entry and your stop loss. So if the distance is, like for this one, the distance is $70, right? So you want, it's 70 pips, it's 70 pips. So you want that 70 pips to be $1 equals to 1 pip. So you just use 0.01 direct. You don't need to do any calculation. You just know that you're dealing with 0.01 because you know your distance with 70 pips. So if you want to have, let's say the distance is 70 pips and you just want to risk half of that, which is 35, you're going to risk, you're going to use what? 0.05, that's 50 cents. Okay, so 50 cents to make sure that this is 35. Are you getting me? So $35, you are just risking $35 here. So why, if we okay, sorry, I think someone called me and then the next.
Okay.
So that's how to use the lot size. Okay. So
okay,
we are using, if it is 0.01 is $1. Okay. When it's 0.2 2 is $2, 0.5 is $5. Then we have the standard lot size, which is 0, which is 1. Standard lot size is 1. So it means that each pip is $10.
Okay.
So one thing you need to do is you need to be very careful on the volume you need, because if you mistakenly use a higher volume and your account is small, but once the market gets to that, it can wipe your account. It can wipe you out. Okay, so you need to use a bigger volume.
So I have one question though. Look, for the take profit. So if the candle movements move and it did get to the line you drew for the take profit, will it still go in your favor or what?
Yeah, it will not go in your favor. It has to touch the line and cross it. It has to touch. It has to take you as the price is about crossing the line. So it must touch it perfectly. It's not just even small touch. It must touch and cross it before the system automatically close you as a take profit.
So if it doesn't touch it and it still moves till when it touches before this.
Yes, it will move until when it touches. It might change direction. Maybe if it can come close to it, just let's say this, and then just let's say this is your point, that this is your take profit. See this one, it came close to it and then come down again. So it might come close to it and come down again, and later go and touch it, or even start a different direction entirely. So that's where I think management comes in. So sometimes you cannot be 100%. So you're not 100% sure that it must get to, but at least if it has moved away from your entry, you can decide to protect your profit by moving your stop loss into the profit zone, so that even if it's coming down, it's not going to hit you at loss again. It's going to hit you at profit, but probably small profits, not compared to your assumed profit. Okay. Yes.
Okay. So now, if you are trading on a time let me say for example, you're trading on 1 minute and you drew a take profit and it didn't reach the line you drew, but and it's up to 1 minute now. So you won't get actual profit there.
No, the 1 minute is just for the candle. It doesn't mean that your trade will take you 1 minute. Although it's because you use a lower time frames, it will just squeeze the amount of time, but that does not mean sometimes market can stay in one place for hours or for minutes, just like this one is not trading. So this is a 4-hour trade. See, on a 4-hour, it didn't even almost, let's say from here, 1, 2, 3, 4, 5, almost 4 hours, it was consolidating. Although until you go to a lower time, right, you see the effects before it started coming. So the time frame just give you how the candle is going to be formed. So it doesn't necessarily that because you enter 1 minute, your trade is going to be after 1 minute, you take profits. No, or hit your stop loss. No, it might be, the distance is going to be less compared to someone that use 4 hours or that use 1 hour. Okay. But that does not mean it will take the actual time to hit your take profit or stop loss, except you are trading binary options. We have binary option that you can say, okay, it's 1 minute. You don't want to stay long. You don't want to know what happened, but you want to stay for just one. So within 1 minute, you show your results, win or lost. So that's binary options. Okay.
Okay.
That one is for trading binary. It's more like gambling. So it's not actually a good trading ideology, but some people who know how to manage it very well. So that way that you enter and say, okay, you want within 30 minutes or 3 minutes, you want to see results, whether take profit or stop loss. Okay.
Okay.
So that one is under binary. But if you are using charts, it depends on how the market moves. You can enter now and the market will start moving, the sharp move, so the distance that we're supposed to take the market 1 hour, you can take the market 30 minutes or 5 minutes to cover it, depending on the volatility in the market at that particular time. So it depends on the volatility. So sometimes it will take the time frame, sometimes it might not just take the time frame.
Okay. So the time frame does not determine the profit you're making or the loss you're making.
It doesn't determine. It just determines the kind of trader you are. If you are using a lower time frame, that means instead of having much data to work with, you just want to work with small data. Okay.
Okay. All right. Thank you.
So that's about the loss size and how to manage the loss size and take profit. the other way of doing, if you enter the trade, you can adjust the trade, depending on what you have. So pretty cool. We're going to look at so the how to fetch entries. I think I have explained how to fetch entries using the moving averages. Okay, so I've explained when the market comes, you always enter as the pullback. Okay, when the market is far away from the moving average, you should be careful of entries. Like I said, the market has drawn and you see it's going that you should not be entering the price sell at this particular level. Wait until it go close to the moving average somewhere here like this, and it's not starting coming down. That's when you should enter a sell. So there's a fresh trade on a moving average. Like for example, using moving average. So you want to buy, you want to sell, like you already know that it's a downward trend. So you don't want to sell this place because it is already far away from the moving average. So you want to wait until it goes into the moving average. So, and it's making a U-turn, it's coming down, so you sell and then target the next support level or resistance level. So you can enter a sell from here and wait for the market to hit here as you take profit. So that's how to fetch. So it's more of like breathe in, breathe out. This one's a breathe in, breathe in, breathe out. So until you see, like this one is about crossing, you just want to be careful that you see a sell setup before you enter, even when it is touching the moving averages. Okay, so you can touch the moving average and is as well break it out and go into the major mean. Okay, so you just they are like guide. They're not like giving you a final say. The indicators are just like guide. You want one thing that you need to give your attention to mostly is the candlestick. Okay, so indicator like moving average are guide, just like giving you a guide that there's going to be a breathe in, breathe out, breathe in, breathe out. But that does not mean it's not 100%. And also that factor of 3 touch, you can see there's this first touch, second touch, 3 touch, it broke it. So if you didn't break on the 3 touch, it might also break on the 4 touch.
But
yes.
So I want to ask a question on this moving average. So in a moving average, you can you said if the price movement is respecting only one of the moving average, it means it's a weak signal.
No, if it's respecting the 200, that's when it's weak signal, or it's not respecting any of them. That's when it's weak signal. If it's respecting one, that is 20 moving average, is a strong trend in that direction.
Okay.
It's very, very strong, but you need to be careful. It's not too healthy. Okay, that's what it is.
Okay.
But if it's respecting the 20 moving average and the 150, is a strong, healthy trend. That one is more healthy, just like what we have here. We have a strong combination of strong and healthy. That's why the market move seriously down. So it's strong and moving. But if it's going far away of respecting the 200 is a week, or is not respecting the 200, it's not respecting any of the trend at all. Okay, in a place where it's not respecting any of the trend at all, is a weak trend. Like this one now, we have a strong bullish trend. Okay, but from here now, I started disrespecting the 20 moving average because it's not consistent like the way it is. Now it's moving between it. So it means that it's finding its way down to touch the 150 and 200, and you can look at the level too. It's almost also a resistance on support level. So it's just like it has its plan of touching them because it's already violating the strong trend line already. Okay, which is 20. So it has broke the 20 moving average. We can now see it's coming down. Although it's not a weak trend, but it's trying to find its balance by touching either the 150 or the 200 moving average, because it has now defined it. So it means that from here now, we know this is a bullish, but the bullish trend has turned to a bearish trend. So,
yes.
so you cannot just open the chart and say, this is a strong trend. Yeah, it's a strong, but the trend has changed in this place. Okay, so it's a strong trend. The trend we are seeing on it now, see it has totally changed. So we can see it coming down and hit this place and continue the up market again. To be healthy, it has to come and touch. So when once it's touching this place, we now call it a strong and healthy trend. But here is only a healthy trend, and which is very, very delicate. It's a strong trend. I mean, it's not too healthy. It's very delicate because it can easily, any small thing, it can break the trend line. And this is what will happen. So it's breaking that trend. But if it's touching it consistently, like what we have here, you can see, it's a strong trend based on this. Well, when it comes to this place like this, see, if you are looking at the parameter from here, okay, let me just clear it. Okay, so if you are looking at the parameter from here to here, okay, you're checking this, but you see, if you look at from this, but you see that it's not respecting any of them like that. So from here, the market is consolidating and is what is a weak trend until it started respecting the 20 from this place. So all these places like is respecting the 20. So you're trying to pull back into the 20. So as you pull back into the 20, we expect it to just bounce off, but it didn't bounce up. It's now breaking it, violating the movement on the 20. That means it's not too, it is strong, it's not too consistent with this level. It means it's finding its way down into the moving averages, and it can go up from there. So with that, we can now call that a strong and healthy trend. Okay. So, but in a situation where it's just respecting, if it's not respecting the 20, it's not respecting the 150, it's only respecting the 200, is a weak trend, or it's not respecting any of the three trend, just like what we have here, is a weak trend. Okay.
Right. Yes.
Okay, so so that's it. That's our practical you've already seen how to fetch entry on the moving average when there's a pull. Don't enter when the market is far away from the moving average, when the market is close away. So be careful as well when it's touching the moving averages. So I think we've done pretty well. The same, we have analyzed the other indicator, the stochastic indicator.
Yes.
That was later, I think I've explained it. So you just use that one to know when the market is overbought and oversold. That guide, you don't trade only with indicator. The keynote of it is get two indicators that support your price action. It makes it very that support your price action, which is the candlesticks, your level and all of. So when once your two indicators are in the same respect with it, that setup has a high chance of being a winning setup going in that direction. Okay, so because sometimes the indicator will be saying different thing, your analysis or your candlestick are saying different thing. So those kind of times you want to wait until they are saying the same thing. When the market is, the indicator is saying buy and it was later saying buy, stochastic or the moving average also is telling you buy, and candle is also telling you buy. That's when, if you have those three in concordance or two of them in the same conglomerate, then that means the market will go in that direction. If they are concurrent together, it will go in that direction. If they are not, it will not go in that direction. There's one we talked about we talk about divergence. That one is deep. I don't know you need that one. We have the divergence of candlesticks and the indicators, especially the oscillator indicators. When the oscillator diverge and it converges, most time it picks the direction of the indicator. So that is how it shows you used to draw divergence. Okay, so if you look at this is divergence. This one is going up, this one is coming down. And once you have a divergence, okay, you draw it using the charts. If you're looking at the trend line, this one is coming down, this one is going up. So it means most time the market pick in the direction of the candle because this one is going. So when the divergence occur like this, it means it will pick the direction of the candle. So these are all trading strategy. So the easy, simple strategy is understand your candlestick, understand your level, know how to fetch the psychological level by looking at the candlesticks that are forming, the reversal candlestick, the pin bar, the inside pin bar, the doji, all of those candlesticks. You need to find them on your levels. But once you find them on level, you always buy when the price is at support. When the price is bouncing out of a support, that's when you should be thinking of buying at the lower time frame. Then when the price is bouncing out of a resistance, that's when to sell. You buy at support, sell at resistance. So you just need all these indicators to also guide you, to give you more idea, trading idea, to see is what you are doing, is it right or wrong, or just to give you more potence in your decision making ability on the market. Okay, that's what the indicators are. So you don't just trade indicator. Indicators are lagging. So most people don't even trade indicator at all. You see them clear off their indicators and they focus on candlesticks. Okay, candlestick is more potent than indicator, but you just need the indicator to also give you guide, because once you have 2 or 3 things saying the same thing, there's a high chance that decision, that level is going to hold, or that bias is going to hold. Okay, so
yeah,
so you fetch your this thing, then know your numbers, are just what we did now, knowing when to enter, when to exit. So when you buy at support, you look at the nearest resistance level to sell, to exit your trade. Okay, so once you do analysis, look at where the market is going to turn up by using the historical data. You use the top-down analysis, draw your levels. Okay, so from top-down analysis, you shrink your charts, you zoom in. It's just like you are zooming in to see more brighter, zoom out, to see more brighter pictures of the charts. So once you see it, you zoom in and see what the candles are doing at that particular level. So if you are buying, you know you are buying at support, and the next resistance is going to be here. So that's where it should be a good profit. And if you are about to enter, you also watch out so where you feel the price should not break. So if you want to sell now, we believe that this is sell setup and the trend is going down, and we have all this thing coming in, and this place is free. We know that our next support level is going to be somewhere here. So if you want to sell this, we want to target this place, and our stop loss should be above the level where the setup is formed. This is setup. Okay, so it should be once it's nullifying the setups, you know that it's now wrong. Okay, so those are the methodology and the ideology you're going to be using, and with your numbers. So once you draw your level, you know what level is talking about, and all of the. Sometimes this thing can conflict. Okay, sometimes it can conflict, but you need to just be careful when you are picking your entry. Okay, because if you look at this chart now, this is a descending channel, and we know what there's a law of descending channel, a continuation pattern. So probably you can also wait. Let's wait and see. Okay, because some people can say, okay, I don't want to be very, I want to be bullish on this. Okay, so if once there's a breakout above, I'll buy and target this.
I'll buy.
Yes. So because this is a descending chart. So when one market is descending on an upward trend, just like it's resting, sometimes it will peak, but you don't know how far it will rest. So we don't know whether it will go, except you look at the level at which it is. Now look at this level. This was a previous resistance level. So if it's bouncing, this has a high chance to bounce from here and turn this place, this region to resistance, turn into support. Are you getting me?
Yeah.
So you can look at it very, very well by looking at okay, you can look at it. Okay, so you see, so you just like this one now, you can't just say, okay, because it's trending, I want to sell, and there's a setup, you also look at where the price is. Okay, so this, because of this particular level here, you see, and we have the zone around this place, so we can see a buy setup, and the market will buy up to this place. Okay, so it means, or more, although maybe probably you now enter around after the breakout. So you are trading the breakout and put your stop loss around here. So there are so many ways of looking at it, and you don't just make decision on any out time frame. Okay, after you cite your entry or whatever thing at the higher time frame like this, you come to the lower time frame and check Okay, you see what is going on the lower down. The market is perfectly expecting, but now it's trying to pull out. So once it pull out, we have a break, we'll buy. Or when once it pull into this place and it's consolidating just the way it consolidated here, we will sell. Okay, so these are the methodology of concepts, and you need to practice, look at them very well to understand this. So I think at this junction, I was able to show you how to do all the analysis, know your number, your take profit, your stop loss, your entry, and different pairs. So we have different pairs that you can trade. We have we have different pairs in which if you have your chart, you have this MetaTrader 5 or MetaTrader 4. Okay, if you have a MetaTrader 4, you click on this. I've explained all these tools to you. Okay, so you can play with the tools. We have different how to use automated trading, your take profit, how to shrink your charts, how to convert your chart to bar charts and candlesticks, all of them, how to change your color. I think I've explained all those things. So
yes,
you want to put more charts that you're interested in, click on create a new chart, click on this, and depending on how the broker is working, you have different broker with their different trading instruments. This FX one, they have these are, I've explained the major and the minor pairs. We have some nasty pairs also. All these one are stocks. If you want to trade stocks on this platform, these are stocks. We have shares of different companies, AAP, Apple, AIG, Amazon, all this you can trade them by trading. We have some platforms whereby you can buy and keep. We have Tesla, we have Twitter, all this. We have Uber, we have all this market to trade. So it's just depending on how much you have in your account and your knowledge about the stock. You can trade anything. You can trade coin and all that. Then we have the energy. That's the 𝗬𝗢𝗖𝗢𝗢𝗧, that's the oil, direct oil. You can trade them if you want. US stocks, Euro stocks. Then for the metal, we have the gold and silver indices. So, but this just gives you varieties. You just need to,
yes,
you don't need to trade any of them because although they move in similar fashion, but in a different way of movements. Okay, so you don't just trade any one of them. You pick the one that you try to study some, the one that fits your career of trading. Then you pick them and trade. Okay, so I think that's what you think you need to do now is to install the MetaTrader on your system, maybe on your phone or your laptop, and you start demo trading, and so you just fix a time when you start demo trading and show me your trading results.
okay.
Yes.
I already have the app on my phone though. I already have the app on my phone.
All these features are on the app. So the MetaTrader is the general app. So it's just for you to register with one of these brokers. Then you have a demo account that you start trading demo so that you practice demo for at least a week. You can trade demo for 2 weeks or 3 to see the strategy and understand how the platform works before you can decide to see how you can go live.
Okay.
Yes.
All right.
So with that, we're going to end the class here. So I see you working on how to get the platform installed on your account and also demo trading. Okay.
Okay. So I already have the app. So I don't know. I think I registered on one of the platform and they gave me a demo account with $10,000 in it. So I don't know whether that
yes.
is
Okay.
valuable.
Okay. So yes, Binance, Binary or Deriv. Once you open accounts, they will give you a demo account of $10,000 where you can start practicing this. So I think that's the best place to start. You can open an account with Deriv. That Deriv account, you go there. You just go back to your back office and then create a demo account. We have the synthetic. Okay, you create a demo account for synthetic. I also create a demo account for currency. Synthetic, you are going to trade only index. So under index, we have the chart is the same. It's just that trading instrument that changes. Okay, so we have volatility 75, we have volatility 100, we have volatility 10, and which are very, very. There are some of the trading instruments are very, very easy to trade. Okay, we have boom and crash. The boom and crash under volatility. So if you download, I think the volatility 75, you can trade it on MetaTrader 5. So you download the MetaTrader 5 on your platform. The reef or binary, they use MetaTrader 5. So once it is being installed, you can now trade those indices. You can create account, demo account for synthetic, for index. You can create demo account for financial. That will take care of currencies and other trading instruments. So I think that's the next thing you're going to do. So you go and create your accounts, then you start demo trading.
All right, thank you.
Okay, so bye.
Yeah.